Thank you. Appreciate it. All right. Well, thanks for coming out. It's exciting to be able to tell you guys a little bit about the world of multifamily and what's going on, because I think you'll see it's quite a bit different from what Caleb was just telling you about. So yeah, I'm Stuart, Sloat, Adam Rezner.
I'm Adam Rezner.
Yeah, and we specialize in just apartment brokerage, and have some stuff we're excited to be sharing with you. And we thought we would start out today with our economic forecast, and then kind of back into why we see things going where they're going. So what we see is that the sales market is likely at or near a peak, but the fundamentals that are backing up where things are excellent, and we think we're going to see some good stability here for at least the foreseeable future. I thought it would be really important for especially multifamily to give some background on where we've come from, mainly since the recession, because it's been kind of a wild ride, and I think you'll see. And then I'm going to hand it over to Adam, and he can show you where we are now with the kind of the fundamentals, and help out with what we're seeing moving forward from here. So this first case study here is an 18-unit apartment building that's actually only about 6 blocks away from where we are here this morning. To give you the history of it, you see there it sold in 2004 for $640,000. And one thing I didn't put on here was it actually sold that same day for $460,000, and then sold later that day to somebody else. It was flipped for $640,000. So shows what was going on kind of before the recession. But I think naturally you can see with what happened in things, it got over leveraged. The owner ran out of money to keep the thing operating properly. Vacancy went up, rents went down, and that 2012 sale, there's 8 years later, it sold for $130,000, which is, I think the bank on this one unfortunately lost about $600,000 on an 18-unit property due to what happened in the recession. So from 2012, that sale there, a significant amount of money was put into the property. The rents were coming back. Management did a great job, getting it stabilized. And so 3 years later, it sold for $800,000, which is, I think that's a little over 6 times what it sold for in 2012. Today, if this owner was motivated to sell, which we might consider, that same property, just over 3 years later is worth right around $1.5 million. Next example here is a little bit bigger property. This is Fairway View Apartments that are out off of Circle. Since we're kind of the tail end of the recession for apartments, here you can see a first sale of this property was just over $3 million, which at the time wasn't all that great a deal. It was decent, but I was pretty shocked to see that a year later it sold for $5.3 million. And 2 years after that, it sold for over $6 million. And that final sale, we're here in 2019, and that was back in 2017 that it sold for $10.9 million. So from 2010 to just 2017, that's I think about a 360% increase in value, as somebody just paid cash for that. And you set aside money that was spent on it, but also setting aside your cash flow along the way. This example is also another 100-unit property that's almost a little more applicable because it did just recently sell for a third time, but it shows going all the way back to year 2000, and it sold for over $5 million, and then over a decade later sold for well over $1 million less than that. But it did just sell in 2018. This was towards the end of the year for $13,600,000. So again, that's over a threefold increase. And none of these are outliers. Even that first property there that and it sold for $130,000 and increased tremendously is just one example that we could give of several that are that extreme, and then we could show you examples like this pretty much all day long. With this one, I did just want to say that it was kind of fun. The broker who had it listed there in 2012 and put it on the market for about $40,000 a unit. It just sat there on the market forever and ever. And I pretty much blew through my phone plan, getting calls from him asking if I had a buyer, which I kept telling him it was overpriced. And that was because I was working on a deal that I got my buyer into maybe 3 blocks north of here for $12,000 a unit at that same time. So you see, from $12,000 a unit to well over $100,000 a unit. It's a pretty insane increase in things. So again, this is giving you a background of just how far things have come up in just the last 6 to 8 years. And so at this point, I'd like to turn it over to Adam to give you a little bit more insight as to what's going on. Adam?
Thank you.
Oh, thank you.
Okay, we're going to take you through some sales and rent data just to kind of back up our outlook, and we'll take a slight detour in there to help explain why some of these prices have risen so high over the last 10 years. So we're going to start off with total sales, and these numbers all are for 5+ units, so no fourplexes or duplexes, any of that. Most recent high water mark as far as total sales was in 2015 with 75. Last year we had 50, which is a bit over the 10-year average here, and quite a bit better than 2009 when we had 19. This next slide is sales volume, and you'll notice it doesn't quite match up with the total sales. We had peak total sales in 2015, but peak sales volume in 2017, $657 million. And a bit of a drop off last year, just under $600 million, but still 12 times what we had in 2010, so not much to complain about there. I actually thought it was going to be a lot less, but we had a huge fourth quarter with over $280 million in sales. So almost half of last year's total came in the fourth quarter. And it's normal in a market this size to have large swings from quarter to quarter. And a lot of that's influenced by the mega sales, the big newer properties that we like to call whales. We'll talk a little bit more about that. Sales price per unit is kind of a way to compare properties of different sizes, more of an apples to apples comparison. The average price per unit in 2010 was $40,000 per unit. Last year it was $140,000, so quite a big change there. But once again, a small drop off from 2017. So what's going on there? Why the drop off? We noticed a bit of a disconnect last year between sellers and buyers. Sellers had seen prices rise and rise and rise, and they expected it to continue forever and ever and ever, which obviously does not happen in the real world. And we noticed buyers and banks getting noticeably more conservative in their underwriting, paying more attention to actual numbers versus projected numbers. And so a bit of a disconnect there, which we think is working itself out now, and it is probably a good thing for the long-term stability of the market. So speaking of whales, this is the biggest whale of all. Sold last year and set a record in terms of total price and price per unit. The total price, $77.6 million. And per unit, just under $241,000. This is up near Union and Powers, for those of you that don't know.
2 slides ago, I think it was, Adam was going through what the total sales volume has been over the last decade or so. This one sale is half again as much as every single sale in El Paso County in 2010. So the market's been a lot more fun for brokers here for a little while.
And Bruce will tell you a little bit more about this, but I think the median price for a home in El Paso County was definitely over $300,000 last year. So not far off from that. You got to be making a lot of money to charge a price like that, and they have been. So let's talk cap rate. For those of you that don't know, a capitalization rate essentially is what your return would be if you paid cash for a property, so no financing at all. And as the cap rate goes down, value goes up because you're paying more for the same income. So I've got 3 lines there. Blue is Colorado Springs, gray is the national average, and then orange is Denver. You'll notice Denver's a lot lower than Colorado Springs, so prices are higher. Why? It's a bigger market, it's got more robust growth, and more resiliency in a recession. So investors perceive it as lower risk, hence they pay higher prices for it. So in 2009, we had a cap rate of about, on average, 8.8%. Last year, that was 6.1%. Pretty big difference there, and we'll go more into that in the next couple of slides. I just want to point out a couple of trends here. The gap between Denver and Colorado Springs has decreased over the last 10 years. In 2009, it was 1.5%. Last year, it was 1%. So what's the reason for that? I think it's a couple things. Colorado Springs has definitely picked up the last few years as far as economy. Additionally, a lot of investors were coming from higher price markets like Denver, like California, looking for higher yield in a solid market, and the increased competition here has decreased that gap a little bit. So what effect does cap rates have on valuation? We'll do a little example here. Take a property that has a net income of $300,000 per year, and at a cap rate of 8.8%, like in 2009, it would be worth $3.4 million. Not too bad. At a cap rate of 6.1%, like we had last year, $4.9 million. So same property, same income, different cap rates lead to very different valuations. And if this was located on the beach in Los Angeles, it might have a cap rate of 3.5% and be worth $8.5 million. It's totally worth it. There it is. Might explain the high number of investors from California in this market. So that's all at the same income. If you combine that with increasing income over the years from market rent growth, from higher occupancy, value add opportunities, you can start to understand the high appreciation on some of those properties that Stuart mentioned. So back to the data. This is rent per unit. The bars are the average rent per unit, and the orange line is the annual rent growth. And so in 2008, 2009, we had negative rent growth, and it quickly rose over the years to a peak of almost 8% in 2016. That was one of the highest in the nation that year. In 2017, it was 6%, and last year, just under 3%. So what's going on here? Is it just going to keep going downhill until it's negative again in a year or two? We don't think so. Just a couple things to point out. You can't have 8% rent growth year after year after year if wages aren't keeping up, and they have not been. Another thing to point out, that black line is 0%. We're still well in positive territory, and as we'll show later on, we believe the fundamentals will continue to support positive rent growth for the foreseeable future. Occupancy. So at its worst, in the first quarter of 2009, market occupancy was 89%. That was the worst it got. I think that's below what you typically need for like a Fannie Mae loan. But it's gotten better and reached a peak of 95% in 2015 and 16. And it's backed off a little bit since then to 93.5, which is still pretty good. I think the long-term average over the last 20 years is like 92. And that's partially due to new construction. It's due to deployments. Last year we had super gays deployed for the first time in years. I think over 10,000 soldiers, which certainly had an effect. And just an aside, you property managers will like this, but we occasionally hear from owners, typically ones who manage their own properties, say something like, "Oh, I've been at 100% vacancy for 3 years." They're very proud of that. Well, your rents are too low and nobody wants to move. Full vacancy is typically 95, 96% because there's always turnover going on. So market rate properties should not be at 100% vacancy or occupancy. Did I say vacancy? Yeah. Okay. You know what I'm talking about.
He's an optimist. It's occupancy.
100% occupancy for 3 years. They should not be at that. All right. So this shows net absorption, how many units are taken off the market or added to in terms of vacant units, and then the number that have been constructed. And this shows quarterly data. It's not the easiest to read, but bottom line, if you added up all the units that have been constructed and all the units that have been absorbed over the last 10 years, we've absorbed more than we've constructed by 1,200 units, or about 2.5% of the overall market. That's data point number one, that we're not overbuilt. Data point number two, each bar shows how many units are being constructed in each quarter, and the orange line shows the percent of the inventory that's under construction. So we're at 4% right now. National average is about 2.5%. So should we be worried? For comparison's sake, here's Denver. they've been over 4% for over 6 years. And there's some debate whether Denver is overbuilt or not. Yardi, which is a property management software company, seems to think they are. But I think you'd be hard-pressed to make the same argument for Colorado Springs. And it's only going to get harder to construct. Rent growth is down. Like Caleb said, construction costs are going up. The length of time it takes to construct is going up. So some of the projects that are in the pipeline just aren't going to pencil out. All right, and then getting into more market fundamentals, this shows the number of households and non-farm employment in El Paso County, and then the rate of growth is those lines. And just to sum it up for you, over the last 10 years, household growth has averaged 1.8% per year. Employment has averaged 2.4% per year. And this isn't the economic forum, so we can't go into all the details of that, but by all accounts, it's not going to slow down anytime soon. This last slide shows, in blue is the single-family permits per year, and orange is the number of multifamily units constructed each year. And the line is how many households we've added to the county every year. We're clearly not keeping up. There's a big deficit there, which is only going to put more upward pressure on rents and occupancy for apartments. So just to sum up how investors see the market, we've got great household growth that's outpaced the new supply coming on the market. We've had very solid employment growth, diversification, especially in healthcare, professional services, and construction, even though it's not enough. And we've got a couple reportedly big employment announcements coming soon. We're in a landlord-friendly state with low property taxes, and we've gotten a lot of national attention recently. So a lot of things to like about the market. A couple of things we're worried about, and I'm going to hand it back over to Stuart for that portion. Thank you.
Yeah, there are two things I wanted to go over here before we conclude what we're talking about. The first I don't have any slide for, but everybody's pretty well aware of it. With the government shutdown, basically a week ago, about 800,000 people across the country didn't receive paychecks. And whether these people own their home or they're renting, that's already putting pressure on people. It's right after the holidays, coldest time of the year, and we don't know how long this is going to go on. That can it's already having a big effect on a lot of people. But one thing I think a lot of people aren't at all aware of yet is housing and urban development. One of the branches of government that's involved in all this has had 95% of its employees furloughed. So Housing and Urban Development HUD handles Section 8 housing, government assistance that is helping out. I don't know the number, but millions of people are on Section 8 housing. One of their responsibilities is re-upping contracts with owners so that the owners can receive that income portion from the government. But right now, nobody's there at HUD to be working with those owners. Already, at the end of December, a bunch of those contracts came up across the country, and owners here as of the 17th of the month have not received, in many cases, a lot of their income. I do believe there's one contract in particular in Colorado Springs that involved 51 apartments where they're not receiving their income right now. If that moves on, we go into February, we go into March, the number of these contracts that are not re-upping are going to double, triple. It could be pretty brutal, and really leaves the owners out there with their hands completely tied, because the government's telling them just to dig into their own pockets right now and cover the costs, and they'll figure it out later. But that'll only last so long, and there are plenty of people too, plenty of owners that don't have deep pockets. They're already running on thin margins. So at a certain point in time, if there's no end in sight, what do? You have tenants who you don't want to evict, and if they are evicted, they'll have an eviction on their record. They don't have the money to move into another apartment. They can't afford the rent in the first place. And these are a lot of senior citizens, people with disabilities that just simply can't do that. They don't have security deposits. If this doesn't end, it's going to get worse and worse, and I guarantee this will be one of the big things you do hear about in the news with what's going on. There's just one area of concern that we're seeing in what's going on in the multifamily market right now, and this is fourplexes. These are at the very small end of the market. It's often people's, the investors' first foray into investment real estate. So they have less knowledge. A lot of these owners, they're not working full time. As part of a company that owns 2,000 apartments where they can really focus on things. They're keeping up with their 9-to-5 job. And the result is, just with less kind of background in it, we see these prices sometimes, really spike up because they're being a little more optimistic than they should be about things. So this example we have up here, we left the picture off to keep the property anonymous. But one evening I was sitting around not too long ago and saw this pop up on my email as a deal at $359,000, which I glanced at and looked like a pretty decent deal until about 2 hours later, I got the email correcting that $359,000 to $539,000, which made me think it might be a good example to talk about here today. This property is sold within about a month. It sold for over that asking price. Now, to give an example, I guess, of how this all pencils out, you can see the monthly income there is $3,450. That translates to $41,000 a year. Being fair with the vacancy, I think I only used about 5% here. You can take $2,000 off of that, and for a property like this, if you have professional management and you factor in your maintenance, your management, your tax, insurance, reserves, supplies, you're probably looking at about $3,500 a unit, which comes out to $14,000. Then, if you're borrowing 80% of that purchase price, even with nice terms at 5.25% maybe percent, I think is what I used here. 30-year and 30-year fixed mortgage, that's coming out to being $29,000 a year, which when you add all those numbers up, gives you a negative cash flow of $4,000 and doesn't make it look like such a hot investment anymore anyway. A lot of the people that do buy these are running their own show, so that helps them cut the expenses back to where this probably will work, or often they're moving into the property. So the other 3 units are offsetting their mortgage, so it works out pretty well there too. But one way or the other, we're seeing these become paper thin margins, and rents don't come up. In this case, they'd have to come up $100 a month per unit to just break even. People might be getting into a little bit of hot water, so hopefully the rents will keep on climbing very nicely. But just a word of caution. While everything else is looking really nice and clean and stable, there are some things that here and there might be getting a little bit into tougher territory. So kind of in summary, to go back through what Adam was talking about, we have great overall basics here. We're at a point where having more supply than demand is fantastic. In Colorado, last year alone, I think 80,000 people moved into the state. And if you break that down, it's something like 20 families a day coming into Colorado in just 1 year. So people want to be here, and that's a really nice thing for all of us across the board in these different industries. Rent growth, it has moderated from where things were just unbelievable for a while, but it is still positive. Employment growth is doing very well. It all really just comes together as kind of a conclusion for you on our outlook that we may be near a peak, but things are still really nice and solid as the underlying fundamentals. So that moving forward, multifamily is still a great place to be investing money for a good long-term investment. And something, if any of you out there are the people that managed to sneak in that 2010 to current market, it's also a great time for people to be kicking back and reaping those gains. If you're at a different point in life where you're retiring, moving, sick and tired of managing your own property, there are some just enormous gains that people have had, and might want to think about taking advantage of. So thank you all very much. We're I think going to be doing question and answer afterwards on things. So I'd encourage you to come up with any questions and really put Adam to the test on all the details of that stuff. So,
Thanks.
thank you.